DFMs weigh up debt exposure as issuance hits record high. DFMs are humming and hawing over their emerging market bond exposure as they weigh the allure of attractive currency valuations against the unknowns of the coronavirus. Investors snapped up $118 billion worth of new issuance from emerging market governments and companies in January. Data from Dealogic cited in the Financial Times shows, despite the emergence of the coronavirus, this was up from $70 billion in the same period last year and an all-time high for the month. We have been surprised by the ease at which the markets have shrugged off concerns around the coronavirus, says Psigma head of investment strategy Rory McPherson. To us, this seems overly complacent. Vere research manager Justine Fearns says debt issuance has remained relatively high as emerging market countries and corporates spy an opportunity to refinance on low yields and make use of currency swings. The record borrowing was mostly in euros and dollars, the FT reported. The dollar had remained relatively soft throughout January, trading around 76 pence against the pound, but this week surged against other major currencies as the coronavirus death toll surpassed 1,100 and investors sought out safe haven assets. It is possible that the spread of the coronavirus is at an early stage, so it may be that emerging markets are looking to capitalize on what has been a relatively benign period in markets, despite the announcement of the virus and a flare-up in tensions between the US and Iran, in anticipation of a potentially greater impact. Fearns says. Coronavirus impact could be hugeWillis. Owen head of personal investing Adrian Lowcock says plummeting yields across bond markets and rate cutting from the Federal Reserve and ECB have kept demand for emerging market bonds high. With so much debt yielding zero or negative rates, this forces investors to take on more risks and look overseas to markets such as debt, says Lowcock. UK domiciled debt funds brought in net inflows of £36 billion in 2019, data from Morningstar shows. Debt was the third most popular fixed income asset class last year, taking in €41 billion of aggregate net flows across UK and European funds, which was ahead of govies and high yield, €23 billion and €21 billion respectively, but behind corporates, €42 billion, and unconstrained bonds, €61 billion. China is very different now. Lowcock thinks the potential for the coronavirus to have a negative impact on emerging market debt is huge, but adds equally the outcome is unknown. If the virus does break out further, then we could see sharp sell-offs, and given the markets tend to overreact, there is likely to be opportunity for fleet-of-foot investors. Comparisons to SARS and previous epidemics are useful but limited, McPherson says. China is very different to what it was back in 2002. It is 8 times the size now, the second biggest economy globally. For more on this story, visit the news article link.